Now I'll run through the questions at the end of the case on page 110 to review some of the important points. Question 1 says, using hindsight, identify factors present at Waste Management that are indicative of each of the three fraud conditions: incentives, opportunities, and attitudes. Management of the company faced many incentives that might have pressured them to engage in fraudulent activity on the financial statements. Management was faced with a pressure to keep the company strong among the top competitors, as well as its reputation during this time, when industry completion was on the rise. Company profits as a result of the increased competition declined. The CEO of the company set earnings targets, which the management was driven to achieve in order to receive higher bonuses if they were able to reach these targets. These incentives encouraged management to find different ways to overstate the company's financial statements. In regards to opportunities, management, when looking at the property, plant, and equipment accounts, found ways to manipulate company performance by taking advantage of the assumptions when calculating depreciation expenses. They did this in order to reach the higher earnings targets. They also didn't record decreases in landfill values and costs of the unsuccessful projects. They made end-of-the-period adjustments spread through many different lines in the financial statements to hide the fraudulent activity. Senior management also overrode other accounting decisions made by others to meet the earnings target. And in regards to attitude, management's attitude was really shown when they refused to make the proposed changes that the auditors had found in the financial statements. This was unethical, and they approached Andersen with a secret agreement, which you can read more about on page 108, to write off the accumulated errors over periods of up to 10 years and to change the underlying accounting practices in future periods. Question 2 says to review Waste Management's consolidated balance sheet as of December 31st, 1996, identify accounts whose balances were likely based on significant management estimation techniques, and describe the reasons why these estimates were required for each of the accounts identified. So, some accounts whose balances were likely based on significant management estimation include accounts receivable, cost plus estimated earnings in excess of billings, property and equipment, intangibles like goodwill, accrued expenses, and unearned revenues. There are a number of different reasons why estimates were required for these accounts. In regards to accounts receivable, this account would be affected by the estimated uncollectible or allowance for doubtful accounts. For cost plus estimated earnings in excess of billings, management was to estimate earnings on contracts that weren't finished yet. For property and equipment, this account was manipulated by depreciation calculation. Estimated useful lives and salvage values were also manipulated. For intangibles such as goodwill, this account relies on estimates of market value. For accrued expenses, management estimated some of these expenses, and for unearned revenues, these may have been estimated values of services not performed. Question 3 says to describe why accounts involving significant management estimation are generally viewed as inherently risky. These accounts would be viewed as risky for a number of reasons. They're based on some assumption and guesswork rather than concrete numbers like other accounts. There's always a level of uncertainty when estimating, especially because you're depending on future events to happen in some cases, and those events don't always turn out to come to fruition. And estimates may be subject to manipulation by management, as management could be biased, and if they're the ones calculating and preparing the estimates, they might have a tendency to swing things in their favor when they're not sure. Question 4 says to review professional auditing standards to describe the auditor's responsibilities for examining management-generated estimates, and also to describe the techniques commonly used by auditors to evaluate the reasonableness of management's estimates. AU 342 Section 7 discusses the auditor's responsibilities for examining management-generated estimates, and it says that the auditor's objective when evaluating accounting estimates is to obtain sufficient appropriate evidential matter to provide reasonable assurance that A. all accounting estimates that could be material to the financial statements have been developed. B, those accounting estimates are reasonable in the circumstances. And C, the accounting estimates are presented in conformity with applicable accounting principles and are properly disclosed. So just to continue with the second part of question 4, which is to describe the techniques commonly used by auditors to evaluate the reasonableness of management's estimates. AU 342 also mentions techniques that auditors can use, and some of the ones it lists are reviewing and testing the process used by management to develop the estimate, developing an independent expectation of the estimate to corroborate the reasonableness of management's estimate, and reviewing subsequent events or transactions occurring prior to the date of the auditor's report. Question 5 says that the waste management fraud primarily centered on inappropriate estimates of salvage values and useful lives for property and equipment. Describe techniques Andersen auditors could have used to assess the reasonableness of the estimates used to create Waste Management's financial statements. The auditors really could have used the steps outlined in AU 342 and applied them to this situation by looking into how management came up with the estimates that they came up with for the salvage value and useful lives, calculating their own estimate based on industry standards to see if it corroborated with the estimate that management calculated, and looking into subsequent events and transactions that might have also had an effect on the calculations. The first part of question 6 asks, what are the risks associated with allowing former auditors to work for a client in key accounting positions? So allowing former auditors to work for a client in these key accounting positions is very risky. These former auditors are aware of what auditors will be looking for when they are auditing a company, and therefore they would be better able to manipulate numbers and perform other fraudulent activities without being detected. Considering these people audited that specific client in the past, they would also have further knowledge of how that company is audited and would be better equipped to go under the radar with fraudulent activity. Also, if former auditors still have strong ties with employees of the auditing firm that they worked for, this could cause conflicts of interest to arise. The second part of question 6 said to research Section 206 of the Sarbanes-Oxley Act and provide a brief summary of the restrictions related to the ability of a public company to hire accounting personnel who were formerly employed by the company's audit firm. The full text is shown here, but just as a summary of what it's basically saying, any former auditor who has been involved with the audit of a client cannot work in any accounting position for that client for at least 1 year after the audit in order to avoid conflicts of interest. So if a company did want to hire a former auditor, they would have to wait at least a year to do so. The first part of question 7 asks to discuss possible reasons why the Andersen partners allegedly allowed waste management executives to avoid recording the accounting errors that they had identified. So there are several possible reasons why Andersen partners allegedly allowed waste management to avoid recording these errors. First, Andersen regarded Waste Management as a crown jewel client, so it's likely that Andersen allowed Waste Management more leeway than they would allow other clients in order to appease them and avoid losing such a major client. Second, during the 1990s, as mentioned before, approximately 14 of Waste Management's key financial and accounting positions were filled by former Andersen employees, so it is possible that auditors would have been more tolerant and willing to let fraudulent activity slide since they were dealing with former coworkers. And third, Andersen allowed Waste Management to write off accumulated errors if they promised to change their fraudulent accounting practices in future years. Therefore, they were willing to sweep past mistakes under the rug, but they did so believing that Waste Management would cease these fraudulent accounting practices in the future in exchange. They put too much faith in their clients' honesty, which may also be a byproduct of their former relationships with key accounts and financial officers. The last part of question 7 says, how could accounting firms ensure that auditors don't succumb to similar pressures on other audit engagements? So accounting firms can ensure that auditors don't succumb to these pressures by making sure that all employees are well versed in their code of ethics, keeping in mind and adhering to Section 206 of Sarbanes-Oxley to avoid conflicts of interest, avoiding taking on clients with so many of their own former employees to also avoid conflicts of interest, and setting standards to ensure that each client is treated and audited according to the same standards, regardless of the client's size or importance to the auditing firm, in order to avoid special treatment for crown jewel type clients.
Thank you, class. I hope you enjoyed the presentation. We'll see you online.